Hi, this is Matthew Cratter from Trader University, and today I want to answer the question, what was Warren Buffett's worst investment ever? If you're interested in learning what works in the stock market today, how to make money in both bull and bear markets, be sure to hit that subscribe button. Now, I should start by saying that I don't mean any disrespect to Warren Buffett by asking this question. He's clearly one of the greatest investors of all time, but I think we can all learn not only from our own investment mistakes, but also from other people's investment mistakes, also really smart people. So Buffett, if you ask people this question, you'll get a few answers, but usually you will not get the real answer. If any of you know of an investment that he's made that is worse than the ones I talk about, you can drop them in the comments below. So if you ask people the question, what was Buffett's worst investment ever? Some people will say Berkshire Hathaway. Now, you may know that Berkshire Hathaway was a textile company in New England that Buffett started buying in 1962. And this was the point in American history when a lot of the textile business was already beginning to leave New England and going overseas. And so it was not, he bought it for very cheap. It was not a good investment. And but he was able to turn it around in a very smart way. He was able to use the cash flows from the business and partially liquidating the business to start investing in insurance companies. Berkshire first bought a National Indemnity Company, and then later it bought Geico. So Berkshire Hathaway, this failing textile business, was morphed into the holding company that really made Buffett the billionaire that he is today. So this was a big investment mistake. It was a declining business, but ironically, it was one of the great. He basically made lemonade out of lemon. So I would say this was definitely not the worst investment ever, though it did take him many, many years. It took him he started buying shares of Berkshire Hathaway in 1962, and he finally shut down the textile operation piece over 20 years later in 1985. At this point, Buffett was already very famous and well known. So that would be the first candidate. I don't think that's a good candidate for his worst investment mistake ever, because it was actually quite brilliant the way he got himself out of it. A lot of people would say ConocoPhillips. Now, ConocoPhillips, obviously an energy company, oil company that Buffett bought when oil was at its peak in 2008. Buffett was buying Conoco right about here. Big mistake, as he's admitted to his investors. If you take a look at the 2008 Berkshire Hathaway letter that he wrote for his investors, which I'll link to below, you can see that he confesses, without urging from Charlie Munger, or anyone else, I bought a large amount of ConocoPhillips stock when oil and gas prices were near their peak. I in no way anticipated the dramatic fall in energy prices that occurred in the last half of the year. So he lost a couple $1 billion in this, I think, when all was said and done, maybe about $2 billion. It's a little bit complicated because Conoco spun off Phillips, and then Buffett did a stock exchange with his Phillips stock for another piece of Phillips. I don't want to really go into the details, but it was definitely a multi-billion-dollar loss. And I find it comforting that even someone like Buffett would buy at the peak. This is when a lot of people were saying we were entering peak oil, that oil would go up in price forever. It looks like Buffett got sucked into this as well as underestimating the cyclicality of an oil company's earnings. Their PEs look very low when their earnings are very high. And then, ironically, oil companies, they'll often trade at very high PEs because when oil prices are low, their earnings are low. And so they look expensive when they're cheap, and they look cheap when they're expensive. I'm sure Buffett knew this, but nevertheless, he made a big mistake, and he's always been very candid about admitting these mistakes. So I think this is definitely up there. I would say it's not his worst investment mistake, though. Next, we have 1993. Famous investment. Buffett bought Dexter Shoes, a shoe-making company, for $433 million. Now, the problem, the worst thing about this investment was that he did not pay cash. Berkshire did not pay cash for Dexter Shoes. They actually exchanged Berkshire stock. They paid with it for stock. This was very unsuccessful. Obviously, shoe manufacturing went overseas in the same way textile manufacturing did. In 2001, which ironically was the same year that China entered the WTO, and obviously was where we've outsourced the majority of our manufacturing capacity, Buffett folded it into another shoe unit in Berkshire Hathaway. At this point, these manufacturing companies were obviously a very small part of Buffett's portfolio. It didn't really matter. But there was a huge opportunity cost to this, which Buffett discussed in his 2008 letter, where he said that to date, Dexter's the worst deal that I've made. We'll see that he actually did a worse investment in the next part of the video. But basically, he gave away 1.6% of Berkshire shares, the value of the company, to buy Dexter Shoes. And so today, Berkshire Hathaway has a market cap of about 450 billion. And so if you take 1.6% of that, he basically spent in current dollars and current market cap of Berkshire, in terms of the opportunity cost, he spent about $7 billion on a failing shoe company. Now, what are the lessons to be learned from this? No sustainable competitive advantage, no moat. There was nothing special about these shoes. I don't even remember the brand. I don't know what they traded at, what they sold for under retail, but it wasn't a Nike type of company. And so this was a huge loss. This was much bigger than ConocoPhillips. A loss of about $7 billion in terms of opportunity cost. And opportunity cost is obviously where you miss out on one opportunity because you're invested in another one. And so this was obviously a very expensive mistake. I can show you where he exchanged his Berkshire shares for Dexter Shoes. It was right about here when Berkshire was still about, I'd say about $13,000 a share. Currently it's $276,000 a share. So the moral of this is, if you're a great investor, you probably should really pay cash for your investments rather than exchanging the stock of your holding company, especially if you're an investor like Buffett, or that you think the underlying stock is going to go up a lot. Perhaps in the early 90s, he thought Berkshire Hathaway was overvalued, and so he was willing to part with it. But as he himself has said, this was a long-term mistake. Finally, we will move on to Buffett's, what I think is his worst investment ever. I'm taking this from Alice Schroeder's book, which is really the definitive biography of Buffett. A great book called The Snowball, which talks about, that uses the metaphor of accumulating wealth. It's like rolling a snowball that you roll every day and you get these compounding effects. It's a very long book, but definitely worth reading. I still enjoy dipping into it. So I'm taking this from this book. His worst investment ever was a Sinclair gas station. Now, these are all over. We have them in Colorado. You can see the map. You probably have one near you. They're mostly in the middle of the country and on the West Coast, not as many in the South, and not as many on the East Coast, though they do seem to be clustered around Washington, D.C. and the New York metro area. What happened was Buffett bought a gas station in Omaha when he was 21 years old in 1951. He went in on it with his friend from the National Guard, Jim Schaefer, and this turned out to be his worst loss ever. First of all, Buffett was notorious for saying how he hated manual labor. He did have a paper route. He did work very hard when he was young to try to accumulate capital, but this really confirmed to him that he did not like working with his hands. He would work, I think he had a number of other jobs during the week, but on the weekends he would work at this gas station and he would actually wash people's windshields. Can you imagine being able to think back and think that Warren washed your windshield when you were pumping gas? The problem with his investment was that there was a Texaco gas station across the street that, in his words, consistently outsold them. The owner of this Texaco gas station, these are Buffett's words from The Snowball, the owner is very well established and very well liked. He beat us every month. That's when I learned the power of customer loyalty. The guy had been in business forever and had a clientele. Nothing we could do was going to change that. And obviously at Omaha, still a fairly small town today, a very small town back then. And so they were basically, Buffett was going up against a really well-established business. And I think this is something this taught him really two lessons: the power of a competitive advantage or moat in terms of customer loyalty. You don't want to open up a business that, for whatever reason, cannot compete with a nearby business. And it doesn't matter what price you pay for the gas station. If you're going up against another gas station that has a moat or an investment moat or a competitive advantage, you're going to get in trouble. So it turns out that he paid in 1951, Buffett paid $2,000 for this gas station. That was his part. I guess his friend paid some other money. But as Buffett tells us, he lost all $2,000. At the time, he was 21 years old. He had a net worth of $10,000. So this was really the biggest loss for him of all time. He lost 20% of his net worth. And right as he was entering manhood, becoming an adult, it must have been quite humiliating. He had to wash people's windshields, and the business still went under, and he lost 20% of his net worth. To put that in perspective, 20% of his net worth today, if you take 20% of Berkshire's his holdings in Berkshire, it's about 14 or 15 billion dollars. And I would say that the other thing that this really helped Buffett realize is that he was a brainiac and still is a brainiac. He preferred a more passive approach to his investments. And so he has this policy when he buys a company, he tries to buy it with very good management. He doesn't bring in his own guys. And obviously he doesn't want to be washing windshields anymore or doing anything like this. So I think this helped him to realize two things. One, that a more passive approach really fit with his personality. Two, you really have to think about the competitive dynamics of an industry. And this is something we can all learn from. To put this loss in perspective, I'm not sure how accurate this calculator is, but it probably is good to the order of magnitude. $2,000 in 1951, $1951 translated into 2020 dollars is approximately $21,000. So not too bad for a 21-year-old to have $100,000 net worth in today's dollars. But you can imagine that it was much more difficult to become rich back then. Today we have the internet. You have all these guys who are 18, 20, 21 who become billionaires. We're kind of used to that. But back in the days when you had to increase your net worth by buying industrial companies or buying real businesses like gas stations, losing 20% of your net worth, 20% of your investable capital must have been quite difficult. So I think this qualifies really as Warren Buffett's worst investment ever. As a 21-year-old, he was still much smarter than I was as a 21-year-old, or as I probably am today. So hope you guys enjoyed this. If you did, hit the subscribe and like button. Hope you guys have a good weekend. And let me know your questions, comments in the comment section below. Thanks a lot for listening, and I'll see you in the next video.